Let me tell you something that nobody in finance wants to admit out loud. The game has changed. Not slowly, not gradually. It changed overnight, and most investors are still playing by the old rules. They're sitting in their tech stocks, refreshing their portfolios every 3 hours, watching the numbers bounce like a rubber ball in a hurricane, and calling it investing. That's not investing. That's gambling with a brokerage account. I've been in the business long enough to know the difference. And right now, in 2026, the single most important defensive move any serious investor can make is one that most people completely overlook. It doesn't trend on financial Twitter, it doesn't get segment time on CNBC, but it quietly makes people wealthy, generation after generation, through every crash, every recession, every geopolitical meltdown, and every monetary experiment governments throw at the economy. I'm talking about agricultural land, real dirt, productive soil. And before you dismiss this as old-fashioned thinking, I want you to stay with me, because what I'm about to walk you through will fundamentally change how you think about wealth, risk, and what it actually means to build something that lasts. Before I go any further, I want to hear from you. Drop a comment below right now. Do you currently own any agricultural land or farmland investment, or have you ever seriously considered it? Because the answers I see in those comments tell me exactly where most people's financial education has failed them. Let's go. Here's the first thing you need to understand. Every single asset class on the planet is built on one foundational assumption, that people will continue to assign value to it. Stocks, someone has to believe the company is worth something. Crypto, someone has to believe the network has value. Real estate in a city, someone has to want to live or work there. Pull the belief away and the value collapses. Agricultural land is different. Fundamentally, structurally different. It doesn't require anyone to believe in it. It requires people to eat. And the last time I checked, and I check this regularly, because I'm obsessive about first principles, human beings haven't stopped eating. Not in any recession, not in any war, not in any financial crisis in the history of civilization. That's not a soft argument. That's bedrock. That's the kind of logic you can build a portfolio on. Now let me give you a number that should make you stop and think. There are approximately 7.5 billion acres of agricultural land on Earth. That's it. That's the total. And that number is not growing. In fact, it's shrinking because urbanization, desertification, and climate degradation are actively eroding usable farmland every single year. Meanwhile, the global population is projected to reach close to 10 billion people by 2050. More people, less farmland. You don't need a finance degree to understand what that equation produces. Scarcity plus inelastic demand equals pricing power. And pricing power, sustained over time, is the engine of generational wealth. I have invested in a lot of things across my career. Some of them were brilliant, some of them were disasters. I've backed companies that turned into empires. I've lost money on ideas that seemed genius on paper and fell apart in execution. But through all of it, the one constant I keep coming back to is this. The best investments are the ones where the underlying asset cannot be manufactured, replicated, or disrupted by technology. You can't 3D print an acre of fertile soil. You can't code your way around the fact that plants need land, water, and sunlight to grow. Agricultural land sits outside the disruption economy. And in a world where every other asset is perpetually one breakthrough away from obsolescence, that permanence is not just valuable, it is priceless. Let me contrast two types of investors, because I think this is where the psychological reality hits hardest. The average investor in 2026 is diversified across a portfolio of tech-heavy ETFs, maybe some bonds, a real estate investment trust, and whatever thematic fund is getting the most attention this quarter. AI infrastructure, clean energy, whatever. They check their portfolio daily. They react to headlines. They make emotional decisions dressed up as rational ones. They'll have good years and bad years, and over a 30-year horizon they might outpace inflation if they're disciplined. Maybe. That's the average. That's what financial advisors sell as smart investing. Now look at the other type, the investor who quietly purchased agricultural land 15-20 years ago, who leased it to farming operations, collected steady rental income, watched the underlying land value appreciate, and paid virtually no attention to the stock market's daily theatrical performance. That investor is not stressed. That investor is not checking apps at 2 in the morning. That investor has built a wealth position that is structurally insulated from the chaos that eats average portfolios alive. And here's the psychological point that people miss. The absence of volatility is itself a form of return. When you're not losing sleep, you make better decisions across every dimension of your financial life. Calm capital compounds differently than anxious capital. In the United States alone, farmland values have appreciated at an average of around 6 to 8% annually over the past several decades, depending on the region and the data source you use. Compare that to the S&P 500, which, yes, has historically returned around 10% annually on average, but with what? With 40% drawdowns. With 2008, with 2020, with the kind of volatility that causes ordinary investors to panic sell at exactly the wrong moment and lock in losses that take years to recover from. Farmland doesn't do that. The volatility profile of agricultural land is dramatically lower than virtually every other major asset class. It doesn't spike, it doesn't crater. It moves with the slow, inevitable gravity of fundamental supply-demand economics, not with the emotional swings of a market driven by sentiment and speculation. And then there's inflation. Let me talk about inflation, because this is 2026, and inflation is not a theoretical concern. It is the lived reality of every person who buys groceries, pays rent, or runs a business. Inflation destroys paper wealth. It erodes purchasing power quietly and relentlessly, the way water erodes rock. Most assets struggle against sustained inflation. Cash is obliterated by it. Long-duration bonds are punished by it. But agricultural land? Agricultural land is a natural inflation hedge because food prices move with inflation, or often ahead of it. When the cost of living goes up, the value of the land producing that food goes up with it. The assets you own appreciates in nominal value precisely when the purchasing power of your currency is declining. That's not a coincidence. That's structural alignment between the asset and the macroeconomic force that destroys most portfolios. Let me push further because I want to get into what's actually happening right now in 2026 that makes this moment particularly important. We are in a global environment characterized by three things simultaneously: monetary uncertainty, geopolitical fragmentation, and climate stress on food systems. Any one of those factors in isolation would be enough to make me think carefully about where I hold value. All three together make me want to own productive, real assets with inelastic demand. Governments around the world spent years printing money at a scale that would have been considered insane before 2020. The consequences of that are still playing out in asset prices, in debt levels, in the credibility of central banks. In that environment, holding value in something real, something you can touch, something that produces food regardless of what the Federal Reserve decides to do next month, is not just defensive. It is arguably the most rational position available. Geopolitical fragmentation is equally important. The era of frictionless global trade, the era where you could assume that food would always flow freely from wherever it was grown to wherever it was needed, is over. We have watched in real time the weaponization of food supply chains. We have watched countries restrict agricultural exports as acts of economic statecraft. We have watched what happens to food prices when major producing regions are disrupted. The countries and investors who control domestic food production capability are in a fundamentally different position than those who don't. Owning agricultural land in a politically stable, water-secure, agronomically productive region is not just a financial investment. It is a strategic positioning in the most essential supply chain on Earth, and then climate. I'm not going to make this a political statement because, frankly, I don't care about the politics. I care about the data. The data says that usable agricultural land is under significant stress globally. Droughts are more frequent and more severe in key growing regions. Water tables are declining in major farming areas across multiple continents. Soil degradation from industrial farming practices is reducing the productivity of land that was once highly fertile. This creates an important differentiation within agricultural land investment itself. Not all farmland is created equal. Land with secure water access, whether from rainfall, aquifers, or irrigation infrastructure, in climatically stable regions is becoming genuinely scarce. Premium farmland in places like the American Midwest, parts of South America, New Zealand, and certain regions of Canada is appreciating faster than the broader agricultural land category, precisely because climate stress is making truly high-quality farmland rarer. This is where I want to address the objection I hear constantly. Kevin, I'm not a billionaire. I can't just go buy 1,000 acres of Iowa farmland. And you're right, in the direct sense. But here's the thing, you don't have to. The investment landscape for agricultural land has evolved dramatically. There are publicly traded farmland REITs. There are fractional farmland investment platforms that allow individual investors to own stakes in individual parcels of verified productive agricultural land. There are private funds focused specifically on global agricultural assets. The infrastructure for accessing this asset class as a non-billionaire now exists, and it's more sophisticated and more accessible than it has ever been. I'm not telling you to liquidate your entire portfolio and go buy a farm in Nebraska tomorrow. I'm telling you that if agricultural land is not represented anywhere in your asset allocation, you have a meaningful blind spot that is costing you diversification, income, and inflation protection. Let me talk about income for a moment, because this is often underappreciated. Agricultural land generates cash flow. Farming operations lease land from landowners at rates that typically yield between 2 and 5% annually on the underlying land value, depending on location, crop type, and lease structure. That is recurring, predictable, inflation-adjusted income tied not to corporate earnings or interest rate decisions, but to the most fundamental economic activity on Earth, growing food. And because lease rates tend to move with crop prices, which move with inflation, the income stream from agricultural land naturally adjusts upward in inflationary environments, the exact opposite of what happens to a fixed-rate bond portfolio. You are being paid regularly to own something that is simultaneously appreciating in value. That combination, income plus appreciation plus inflation hedge, is extraordinarily difficult to find in a single asset class. Agricultural land provides all three. Now I want to talk about something that goes beyond the financial mechanics, because I think the deepest reason most investors ignore agricultural land is psychological, not analytical. We live in a culture that equates sophistication with complexity. The more complicated an investment is, the more acronyms involved, the more moving parts, the more technological abstraction, the more serious it seems. Buying a stake in a 500-acre soybean operation in Illinois doesn't feel sophisticated. It doesn't make you sound impressive at dinner parties. There's no ticker symbol to watch. There's no algorithm generating your entry signal. It's dirt. It's farmland. And the cultural conditioning we have absorbed from decades of financial media says that serious investors do complex things with complex instruments. That conditioning is wrong. Some of the most sophisticated financial thinking leads back to simplicity, to assets with clear, durable value propositions that don't require ongoing faith in market sentiment to maintain their worth. Agricultural land is the ultimate expression of that principle. Its sophistication is in its simplicity. Its power is in its permanence. I want to address one more objection before I move to what I think 2026 specifically demands from investors. Some people will say, but farmland doesn't have the upside potential of equities. And they're right, in the same way it's right to say that a fortress doesn't have the mobility of a sports car. True. But what does a fortress have that a sports car doesn't? It's still standing when everything around it has been destroyed. The comparison is category error. Agricultural land is not a growth investment in the venture capital sense. It is a value store, an asset that preserves and methodically grows your wealth across market cycles while providing income, inflation protection, and correlation reduction across your portfolio. The question is not whether farmland beats the NASDAQ in a bull market. The question is what happens to your total financial position across a complete market cycle that includes both bull markets and the inevitable corrections, recessions, and crises that follow them. In 2026, the argument for agricultural land as a defensive anchor has never been stronger, and here's specifically why this year matters. We are entering a period where traditional safe havens are less safe than they appear. Government bonds in many jurisdictions are still offering real yields that barely keep pace with inflation, if at all. Gold has had its run. Cash is a slow-motion loss in real terms. The equity markets, while resilient in headline terms, are carrying valuations in certain sectors that require an enormous amount of future growth to justify. In that environment, expensive growth assets, impaired traditional safe havens, persistent inflation risk, and geopolitical uncertainty, a real, productive asset with inelastic demand and long-term supply constraints is exactly what a rational, serious investor should be adding to their portfolio. And here's the part I want you to really hear. Wealth preservation is not sexy. It never has been. The financial entertainment complex is not built around stories of investors who quietly compounded their wealth over 30 years through boring, durable assets. Those stories don't get clicks. They don't generate engagement. They don't build TV shows. But those are the stories that end with generational wealth. Those are the investors whose grandchildren are financially secure. The investors who chased the narrative, who piled into whatever was hot, who took maximum risk in pursuit of maximum return. Some of them got lucky. Most of them ended up back at zero at least once, often at exactly the wrong time in their lives. I have watched this pattern repeat throughout my entire career. The investors who consistently win over long time horizons are not the most aggressive. They are the most disciplined. They are the ones who understand that protection of capital is the first rule of wealth, not the last. Agricultural land is the manifestation of that principle in asset form. It forces patience. It rewards time. It generates income while you wait. It appreciates with the economic forces that destroy other portfolios. And it does all of this while being grounded, literally grounded in the most essential human need. You're not betting on whether a technology will be adopted, whether a CEO will execute a strategy, whether a government will maintain a currency's value. You're betting on the fact that human beings will continue to need food. That's not a bet. That's physics. Now, if you're sitting there thinking this is all theoretical, let me ground it in real behavior. The largest institutional investors in the world have been systematically increasing their agricultural land allocations for years. University endowments, sovereign wealth funds, pension funds managing retirement assets for millions of people. These are not organizations making emotional decisions. They are executing analytical frameworks with long time horizons, and they have consistently concluded that agricultural land belongs in a serious institutional portfolio. Harvard's endowment, TIAA, the Canada Pension Plan, the Queensland Investment Corporation. These organizations hold farmland at scale, and they have been adding to those positions, not reducing them. When the most analytically rigorous, longest horizon investors on the planet are consistently moving in one direction, paying attention is not optional, and yet the average individual investor has zero agricultural land exposure. Zero. Their portfolio contains no allocation to the one asset class that institutional giants have been quietly accumulating. That gap between what institutions are doing and what individuals are doing is not evidence that individuals are smarter. It is evidence of an information and access gap, a gap that is narrowing thanks to modern investment platforms. But that still represents a significant asymmetry in how different types of investors are positioned for the decade ahead. I want to talk about one more dimension of this that rarely gets discussed: the social and political durability of farmland as an asset. In an environment of increasing political populism, wealth taxes, capital gains debates, and regulatory pressure on financial assets, agricultural land often receives treatment that reflects its social utility. Food production is not just economically essential, it is politically essential. No government, regardless of ideological orientation, can afford to actively undermine the viability of domestic food production. That creates a de facto floor of political protection for agricultural land that does not exist for most other asset categories. I'm not saying farmland is immune to regulatory change. Nothing is. I'm saying that the political risk profile of agricultural land is structurally more favorable than, for example, financial assets, which are perennially in the crosshairs of governments looking for revenue. Land that grows food has a constituency that transcends politics. That matters when you're thinking about where to hold value over a 20 or 30-year horizon. And speaking of long-time horizons, let's be direct about who this conversation is actually for. If you're day trading, if your investment horizon is measured in months rather than decades, if you're fundamentally oriented toward short-term performance, agricultural land is not for you. And I wouldn't pretend otherwise. This is a long-game asset. The people who win with farmland are the people who understand that time is the most powerful variable in wealth creation, and who have the discipline and the financial structure to let time do its work. If that description fits you, if you are building wealth that is meant to compound across decades, that is meant to survive market cycles, that is meant to be transferred to the next generation with its value intact, then agricultural land deserves a serious, thoughtful allocation in your thinking. Here's where I'll land this. The fundamental question of investing is not what will perform best next quarter. The fundamental question is what will still matter in 10, 20, 30 years. The answer to that question, stripped of all the complexity and noise and narrative of the financial markets, almost always leads back to real things, real assets. Things that cannot be conjured by a central bank, replicated by technology, or rendered obsolete by the next wave of disruption. Agricultural land, productive soil in regions with secure water access, growing food for a growing global population on a planet with a fixed supply of viable farmland is, by that standard, one of the most compelling answers to the fundamental question of investing that I have encountered in 4 decades of managing capital. It is not exciting. It is not a headline. It is not going to trend on social media. But it will be there, producing, generating income, appreciating in value, holding its worth against inflation, while 100 other opportunities have come and gone, enriched some people who timed it right and destroyed many more who didn't. That is the difference between investing and speculating. That is the difference between building wealth and chasing it. And in 2026, in this particular moment of monetary uncertainty and supply chain fragility and climate stress and geopolitical reorganization, choosing to own a piece of the world's food production capacity is not a conservative move. It is a sophisticated one. The people who get wealthy and stay wealthy are not the ones who constantly seek the most exciting opportunity. They are the ones who understand value at a fundamental level and have the conviction to hold it when everyone else is distracted by something shinier. Agricultural land is one of those fundamental values. It has been for 10,000 years. It will be for 10,000 more. Now, I want you to do one thing before you close this video. Go to the comments right now and tell me what percentage of your current investment portfolio is allocated to real, tangible, productive assets, not ETFs, not REITs on paper, but actual physical assets with direct ties to economic production. I want to see where you stand because that number will tell you more about your actual risk exposure than any financial advisor has probably ever told you. Drop it below. I read these, and if this video made you think differently about where you're holding your wealth in 2026, share it with someone whose portfolio needs this conversation. Because this is not the kind of thinking that gets pushed to you by the algorithm. This is the kind of thinking you have to seek out. And the people who seek it out are exactly the people who end up on the right side of economic history. That's it. That's the argument. Agricultural land, real value, real durability,